Good morning, good afternoon, good evening. Welcome to the Playbook of the Wealthy. My name is Dave Grant. My co-host is Heather Townsend. Today, we are talking about a passive loss gotcha when you're investing in real estate. So if you don't want to be got with the gotcha, then keep listening. Our podcast is split into 4 sections. We're going to share what's going on in our professional lives, our personal lives. We're going to dive deep into content, and then we're going to answer questions. If you haven't been here before, please like, follow, comment, subscribe, share it with your mom, put it in the group chat, and do a smoke signal to your neighbors so they know what's to listen to. If you have left a like, a comment, subscribed, you've sent it to the group chat, thank you. We are aware that our reach is growing and our YouTube views and subscribes, they're all going up. So we appreciate you very much.
Thank you.
If you wanted to hear from Jordan, because that's the part of the show you enjoy, you're going to have to wait because he's coming at the end. Our first section of the podcast, you get to know us professionally. Heather's going to go first. Ready, set, go.
Okay. Wow, that was
How
fast.
are you?
I'm doing really good. This was actually, again, one of my weeks of trying to catch up. It's a short work week this week. It's July 4th week as we're recording this, and it is not a quiet week. So I have Lisa, my employee. She reviews cash balances in Schwab every month, right? To just see because in my clients' brokerage accounts, I don't have automatic reinvest on because I want to use the dividends to reinvest, to rebalance.
Interesting. We'll talk about that later.
Yes. And so all of a sudden I get these notifications. I think I have 25 trade requests right now, sitting. So that kind of took my quiet week because big dividends from some international ETFs this month, surprisingly. So that's going on. And then, I'm kind of on the seat, just waiting for the legislation changes to see what gets passed with the BBB bill. I cannot call it its real name. It's just too hysterical and I can't take it seriously. So my clients and everyone is used to me saying the BBB bill. That's the tax bill, if anyone's wondering.
Don't get it wrong and say the BBL bill.
What's
It's a butt lift.
I did not know that.
Yes. So BBB, the Better Business Bureau bill. Anyway.
Okay. Yes. Okay. Big Beautiful Bill is what it's really called. Anyways, BBB bill. And there's also changes in student loans that could be coming down. There's just a lot that this is going to be a big year with legislation that I'm just watching and kind of sitting on my seat, seeing the notifications coming through.
Agreed. All right. Why'd you let your dividends go to cash instead of being reinvested?
I reinvest them. I just like to choose where they get reinvested in the brokerage accounts.
Doesn't that make a lot more work?
It does, but I don't like to rebalance. A lot of my clients are in high tax brackets. So I like to rebalance with dividends and money coming in versus having to sell stocks with capital gains or holdings with capital gains.
Okay, fair enough. All right, this week, time management has done a number on me this week. It's end of quarter. So it's trading, billing, reporting, all of that, while still trying to do client stuff, while still trying to get all this done in a 4-day work week and, record, edit, publish, all those things. This is not enough hours in a day. And I'm not going to be like you who gets up at the butt crack of dawn to get to work. I refuse to do that. So I would just either work late or it's just going to sit there and flow into the next day.
Do you get text messages from me and look at the time and be like, wait, she's up her time and you're probably not even up yet your time and we have a 2-hour time difference?
So I wake up in the morning and if there's something that's on my mind, I will text you from bed because I don't want to get up. And then you text me back and I'm like, she's up early and I know you're at your desk.
Oh, yeah. Oh, I'm 5:30 at my desk.
No.
I know.
If you text me that early, I'm not responding.
But I'm my brain is about mush around 3 or 4 p.m. because I've been working for so long after that point.
And then you get to go home to 2 girls, a dog, and a husband.
Yeah. It's what I wanted. I love it. Yes.
Yeah. Let's dive in. All right. Heather prepped this. I am going to be the listener's guide through this material because I don't know it as well as Heather. And so Heather is going to be our expert here. So Heather, you're going to start us, and then I'm going to chip in and make sure that it's easily understandable.
Okay. So first, I'm going to apologize again. I feel like I'm constantly apologizing for the tax code. I didn't make these rules. They're nuanced, complicated, exception upon exception. I tried to write this in the way that my brain thinks so that you could understand this and take this away. But one thing that I want to start out with is there are gotchas with deducting losses with rental real estate. And this gets wrong. I think there's a lot of miscommunication out there or misinformation out there, especially with social media today. So I'm going to give you the rules as being a CPA, and I want you to think about it in two buckets. We're going to talk about short-term rentals. So think Airbnbs, your average rent stay is less than 7 days or 7 days or less. That's going to be a different bucket. I'm going to first talk about, let's say, the average rental income property that you rent monthly. Maybe you have an annual lease. We're going to start there. Now, in general, rental real estate income and losses are considered passive income. And that is it has the IRS code. Okay, so let's say you have a passive loss. Dave, do you think you can offset that with capital gains? Like the passive loss?
What does passive mean?
Okay.
Or can you give me some examples of what is a passive income or passive loss?
Yes. Okay, so what we talk about with passive in the income space, like that is all the rage right now. I want to earn passive income, all right? Where we think of that as I didn't have to work or put in any time to make money. It just comes into my bank account, right? The IRS has a different definition for passive. So let's start there. Of course they do. So let me give you some examples of what is not passive that is surprising. Capital gains, interest and dividends. Is your mind blown yet? Very confusing. How is that not passive? Well, not per the IRS. What it is like rental income is considered passive. And if you invest in, let's say, a business, you're getting a K1 for that investment in a business, you are not actively participating in that business. You are literally a silent partner and you are getting a K1. That is passive.
Gotcha.
Those are my two examples. Okay. So I want you to think of when we are talking about passive, we are thinking of that type of income. We're not, okay. So we titled this Gotcha with Real Estate Taxation, right? I'm just going to give you the gotcha. Everyone gets so excited about rental losses because of depreciation. Depreciation most of the time puts people in loss position, right? It offsets the rental income. Would you agree?
Mm-hmm.
They're like, ooh, I have losses. I can offset. Yeah, no, because they get suspended unless you can only offset passive losses against passive income. I'm just going to let that sit for a second.
Okay. So the income that you get, you can offset with depreciation.
So my business income can't offset that with real estate losses because it's ordinary income. I can't offset my capital gains. I can't offset my interest and dividends with real estate losses. Now, there are exceptions. It's the IRS. Are you ready? Okay. So if you are a real estate professional, I'll go into defining that later, you can offset rental losses against your ordinary income. Okay?
So regular Joe can't, but a real estate professional can.
Mm-hmm.
Okay.
Do you want me to just define what a real estate professional is now?
Yeah, no, I'm intrigued.
Okay. So it's if you spend 50% or more of your time is spent in real estate activities. So you and I, our full-time job is running our business. There's no way I could, okay? The other thing is, and you have to spend at least 750 hours on real estate activities. It's both. 50% of your time, 150 hours. That's a real estate professional. Now,
so that's a really
yes,
narrow definition.
It is very narrow. Like real estate agents, that's their full-time job, of course. All my real estate agents are real estate professionals. Easily, right? That makes sense. That's the best easy example I can give you. I also have a friend that literally his job is investing in real estate. That's all he does. He's fixing and flipping, having rentals, like just you name it. That is all he does. He's definitely a real estate professional. Okay. The other way around it, if you aren't a real estate professional, is you have to actively participate. So you have to own at least 10%. You can't be a limited partner. So if you have a rental property, you have to own more than 10%. Probably you do. And you make key management decisions, right? You're approving new tenants, approving repair, you're deciding the rent, you're actively participating. But guess what? This is why I don't really talk about it very much. it starts phasing out of you being able, you can deduct, if you actively participate, which I just talked about, you can deduct up to 25,000 of rental losses against your ordinary income, which sounds great, right? You get excited.
Yeah. So your definition of active participation there. So if I own 100% of a rental house and I approve a tenant, which most owners do, doesn't that then count me as being an active participant in managing that rental?
Yeah. Let's just say you're making most of the decisions, right? You can still have a property manager, but you're still making most of the big decisions. You would fall under active participation.
So doesn't that cover everybody who has just bought a investment property and has a renter inside there?
I know. Are you ready for the gotcha? Remember, we called this gotcha.
Dang it. I thought, okay.
Yep. It starts phasing out at 100K of AGI.
Okay. I don't know anyone who makes less than 100 who owns rental properties, because that's okay.
And it fully is phased out at 150 AGI. So that's why, like, unless you are a real estate professional or make low income, forget it. Now, these losses don't get lost. They get suspended and carry on indefinitely. And then when you go and sell the property, you can use them, right? But like this whole idea of if you have a property, you're so excited about depreciation and you get to offset your ordinary income, like, no, not if you're high income or unless you're a real estate professional. And I mean, one way that it's really helpful is one of my clients has a property bought at the right time. Very weird situation, but the amount of rent that they can collect on their property is very insane. Like the depreciation is going to help them. Their cash flow from this rent is enough to someone to live off of, for gosh sakes, right? Like, I don't even think the depreciation this is our first year. I don't know if it's even going to offset all the rental income. I don't know, right? We're going to have to get into the basis and all of that. But point being is like this whole idea of offsetting like losses, unless you have other passive income, then it's great because you're offsetting it with the depreciation. And so maybe you're getting that rental income that you get to live off of. But you're not offsetting the losses though from ordinary income. That's where the mess up, like I think the gotcha gets. Am I making sense? Yeah.
So unless you're a real estate professional, the losses really aren't going to help you if you're earning income from a job and you're earning over that $100,000.
Now, there's another exception. Are you ready?
Stop with the exceptions.
I know it's annoying that I make this joke. With the IRS. It's like exception upon exception upon exception. Like you can't just take one rule and then just be like, oh, that's the rule. Nope. That's why.
What's next?
Okay. Now, the exception and the big exception that I think people do miss a lot of the time is Airbnb income, short-term rental income, let's say, short-term rental properties. There is a loophole. And this is where if you are a high income person and not a real estate professional, there is hope for you to deduct your real estate losses from your ordinary income. So you pay attention right now. So under IRS rules, if the average guest stay is 7 days or less, the activity is not classified as a rental, but rather a business. I know. It still goes on Schedule C as rental income, but it's now a business. Okay. And it can count as material participation. Now, I'm going to jump ahead. What that means is and I'll tell you how you meet it, but if you materially participate in your Airbnb rental, you can use those losses and deduct them from your ordinary income.
Okay.
I know.
How'd you get the average guest stay? Is that something you just calculate over the year? The length of time someone was there? Okay.
Yeah, have the property management company. So because short-term rental income is not considered passive. I mean, Isn't this crazy? Like, so, I mean, our tax code has gotten way too complex. I don't think anyone disagrees with that. I mean, I forget how many pages it is now and where it started, but it's like absolutely insane. So there's 7 tests that the IRS uses for material participation. I'm not going to bore you with the 7. I'm going to go over the top 3 that most people fall under and where my clients fall under. Okay. You can choose one of the 7. Okay.
So you only have to qualify with one.
Yes.
Okay.
You spent 500 plus hours on managing this property, working in this property, whatever. You did substantially all the work. That's the second one. More than any other person. or you did at least 100 hours of time working on this property and no one else did more than you. So some summary think that you needed to spend somewhere between 100 and 500 hours and spend the most time on it. So, I have two clients in this situation that were using this. One of them does have a property management company, but it's still a lot to manage. They approve every tenant. They have to figure out the furniture. They're constantly going there, maintaining it. And here's why this gets really interesting. This is where the cost segs that I talked about in one of our previous episodes make sense, because if you have a really high ordinary income earner, like a W-2, or they own a business and they have a lot of income, they're in the 37% tax bracket, you're going to want to cost seg, accelerate depreciation, and offset as much of that depreciation against their ordinary income. That's where it starts making sense. And so again, it's complicated. There are gotchas. You need to have a tax strategist or a really good CPA if you're getting into real estate. One of my clients that has an Airbnb, their Airbnb has really slowed down. And I think in the Arizona area, a lot of properties have gone for sale because Airbnb demand is down in the beginning of 2025. I think people are starting to prefer hotels again, is kind of what I heard. I mean, I don't own an Airbnb, so I'm not really all in this. And I guess fees have gone up and all of that. Mm-hmm. I don't think you just get an Airbnb for tax savings. But I think if it fits within your plan, which I can go through at the end of the episode of like something I'm thinking about for my own plan long term. But yeah, this is complicated.
So there's almost two different strategies then. Like if you want to invest in real estate, you've got to decide, okay, do I want to get the Airbnb classification so I can then start reducing the taxation of my personal income by using the losses on that real estate to offset that? Or am I doing it from a long-term investment standpoint where I don't get to do that, but I'm in it for the appreciation of the property, and I'll just pay taxes on the rent as I go?
Well, and you're still suspending the losses, which you can use later, right? But I just think if you're doing a long-term rental versus short-term rental, you need to understand that there are different tax rules. That's the main thing that I really wanted people to understand in this episode today. And if you have a long-term rental and you're not a real estate professional and you have high income, just have a strategy of how you can get those losses out of suspension at some point.
How would you then advise people if they're starting to get into real estate in terms of what approach they should be taking? Should they be looking at their income in terms of their approach, or is there something else that goes into it?
I wish I could just give some easy answer to this, but I'm not a fluffy person. I can't. I think it so much goes back to the client's plan. What I can give is an example of me right now. Okay. Right now, I'm in Park City. We come here every summer, and I'm going to actually fast forward to my highlight. This was what I was going to say at the end. And we are just so happy up here. Every year I come up here, my kids are playing outside. We have a nanny up here. I mean, this is my happy place. Like, I've gone for a walk every day, and we have rented the same place for the last 3 years. And this is the one place I think Alex and I would buy in a heartbeat. Now, Park City is very expensive. This is not some small investment, okay? But this is the place I would want to buy. And I was thinking with Alex, and I was like, we're in our really high earning years right now. This is where we're really trying to put away money for financial freedom. Taxes are one of our biggest expenses in our household. I can't deny it. Mm-hmm. And I try to do as much as I can to offset it, but still taxes is very high for us. And I was like, wait a minute, like buying one of these, we would rent it out on Airbnb for the winter months because we don't ski a lot. And I would love to offset some of this from our short term because I want it for the summer anyways, right? So, and I would come up here and work on the property to get it, to work on furniture, work on getting it set up for the next winter season. Could be really smart. Of course, you've heard in other podcast episodes, I've done the numbers. I'd still be in a very significant loss. But at one point, this also comes to like the plan of this is what I want as part of my life. I would love to have a second home here for my family for years and years to come. So it fits within my plan, right? But if I didn't love it here and you were like, all right, Heather, Airbnbs are doing really great in, I'm going to throw out some really Kansas. I'm going to throw out some really weird state. Do I want to go manage and buy a property in Kansas that doesn't go any part of my plan and have an Airbnb on my household? No, I don't.
All right, let's jump into the question segment of our podcast. It's called What Would You Do? Question 1. My main job is killing me with taxes. Do I buy real estate to offset the taxes?
You answer this one, Dave.
It's one of the advantages of having real estate, but if real estate doesn't fit into your overall plan, then the answer is no. That's kind of it. Question 2. If I have suspended passive losses from past years, how and when can I actually use them?
So, reminder, you can carry these indefinitely, carry forward them indefinitely. So you've been stacking them up. You can offset future passive income if the property ends up making income. Or when you sell the property, it unlocks all those suspended passive losses that you've accumulated. And you can use them to offset your gain on the property.
Nice.
Mm-hmm.
All right. In our previous episode, we were talking about depreciation and bonus depreciation. And then that, if you sell it, can get recaptured.
Mm-hmm.
Can the losses be used against that recapture?
For my research, yes.
Awesome.
Yeah.
So it will definitely help you at some point. It just might not be right now.
And that's I can't say this enough. Having strategy with real estate is so important here. I mean, look at all these rules we're talking about. Knowing what you're getting into, what the income will be, what the losses will be, how you can utilize them, when to utilize them, when to sell. I mean, you definitely want to have a plan and strategy for this. Because I think doing it wrong or missing it or not having the right CPA who knows some of this stuff, you could miss a lot of opportunity.
For sure.
Yeah.
Even if someone came to me and said, I'm a real estate investor, I would like to use you as my advisor, I'd be like, nope, I'm sending you somewhere else because this is complicated. I don't know much about this at all. All right, last question. Can I qualify as a real estate professional to fully deduct rental losses, even if I have a full-time job outside of real estate?
Fluffing no. I mean, normally I'm not the no woman, right? I'm not the no woman. You know that.
Sound like me from the last episode.
Yes, exactly. No. But now I'm like, no. Like, I'm not going, like me, Heather Townsend, who has my main job is Townsend Financial. I am not going to qualify as a real estate professional. And if I got audited, I'm pretty sure maybe the IRS would come after and take my CPA if I tried that one, because that would be laughable. Now, let's say though that Alex now, my husband, decided to retire early. He's not, but let's say he did. And he was staying home and we decided to get all these rental properties and he was managing them. He could qualify as a real estate professional because that is his full time. He is doing that full time. So the spouse, if you have a spouse at home that is managing these properties full time and they don't have a main job, that might be your workaround to qualify as a real estate professional. There, I was a no, but there is a yes. There is a possibility. There is an idea.
All right, we're going into our next segment. It is called Highlights. Heather's already given us her highlight because she just talked about Park City and how she wants to buy property there.
There's more.
Okay, go for it.
So this time renting this place, it was really weird. Normally the rental company is on it. The owner loves it. We give an offer. We pay all up front. It is great. They love us. This year, trying to get this place was really hard and I couldn't figure it out. And then I just found out that the owner sold the property. I am devastated right now.
Okay.
This is like our place we go to every summer. I mean, there is like my girl's Play-Doh still in like this groove of the kitchen table here. Like it is like, you can tell like the Townsends are the people that rent this place probably more than the family. And
hold on. You
what?
Go there once a year and your Play-Doh is still in the groove of the table?
Yeah, in this like little hidden groove.
That's gross.
Well, I can't get it out. What do you want me to do? The girls did it. You know, kids, they shove stuff in every little crevice they can find. It dried up. I can't get it out. I don't know what to do. It's in the screw. Okay. Point being, so today, my lovely nanny was here and that we have up here. And this family was like taking pictures outside. And my nanny was like, dude, are they the owners? And I'm like, no. But I'm like, I'm going to go around to the front because if they come around to the front, then they're definitely the new owners. It was the new owners. And who's Heather? Heather goes out. I talk to them. I get the whole full download. I tell her everything I would change about this place. Let them come in. I mean, I get her number and I find out that it was through the grapevine. It never went on the market, but their realtor got somehow wind that this owner wanted to sell it. It was completely under the table sale. It was right before I guess it sold in March or April, right before we would have sent the cash for our remodel. There's no way I could have done both. But I'm just really bummed and super jealous of this family. And it has made me, because I don't know if we're going to be able to rent it next summer because they are from Florida and they are going to use it in the summer. And so I'm in this like mourning and realizing that this is something I really want. So it's also like a gift too. It's like, I've questioned this, but this is really telling me that this is something I want to do for my family at some point. Really huge goal, really huge financial goal I have. Park City is one of those areas that just went crazy during COVID. Like the property values like doubled. It's insane. And it has not come down. But yeah, I don't even know if it's a highlight more that it's just it's a gift that I realize how jealous I am of this family, but like, I'm really sad and I don't know what our next summer is going to look like.
Man, it's all change.
Yeah. Yeah. So, but I have her number and I was really sweet to her, and her son is a financial advisor at Fidelity. And so of course I was like talking shop with him and he kept asking me questions. So I'm like, I'm hoping that there was enough that I left that they're like, oh, she was like, what's your name again? I love you. And I was like, okay, good. Maybe this good juju is going to pay off. And like now they know my number. So I'm hoping like in 5 years where I am maybe in a position where I could easily buy this, that maybe they're done with it. And that's how it happens. I'm just going to put that out in the universe.
There you go.
I know. I hope everyone hoped for me because this place feels like our place.
Well, I'm happy and sad for you.
I know. Me too. All right. What is it, Dave? What's going on?
My highlight. Let's talk about Trump's BBL. So the big, beautiful bill has a provision in that as of recording is not yet finalized, but it's all about EV credits. Trump wants to get rid of them. So the timeline was going to be the end of the year. Now it's end of September. And in my big old timeline, I am going to give my car to my son Eli when he turns 16 in March, and that can be his car to drive. I was then going to buy a Tesla in March and have that be my car. Now my timeline is accelerated to get it done by the end of September, if that is the date. That date is now going to just cause a huge crunch of people trying to buy EV cars to get that credit. So now I'm scrambling to say, okay, I don't want to jump too early because it's a big decision. I do want a Tesla. I'm ready to buy one. But I also want to make sure that I get the credit too. So I'm just being that annoying husband walking around the house giving all these tidbits to my wife. I'm like, oh, you're an educator. If you buy the car, we get $1,000 off. Or I want to find out people who have Teslas so I can get their referral code so I can get some type of benefit.
My gosh, I don't even know.
I've been that guy.
That's great though.
Now I've researched this for about a year to get the car. Like I've test driven a car. Like I've done all of this. So I'm ready to buy it. But it's now quicker than the timeline that I wanted it to be. So that's causing me a little bit of stress.
Wait, hold on. Isn't there also an EV credit? And again, the tax code, I always have to research and double check, but something is telling me there's also an EV credit for used EVs. Is that true?
So new is 7,500, used is 4,000.
Okay. But I hear like used Teslas right now are like a really good buy. Like you can get I'm just saying, let's pretend a new Tesla is like 50, but you can get a used one for 20 and it's only like a year old. I'm making something up. Wouldn't you save the 30 and take the 4,000 tax credit?
So in my research, I'm going to get the Model Y that recently went through a refresh at the start of 2025. And it's a whole new car, new suspension, new everything that they have done to improve the car. I have never owned a new car. And now I'm at a place in my life, I'm like, dang it, I worked hard to build this business to where I want it to be. It can cash flow a new car, it can cash flow a used car. Doesn't matter. So now I'm like, I want a new car.
Hey,
so
Dave.
Go get a new car.
Is a Model Y above 6,000 pounds?
I just had this conversation in my boys' chat. No, it's not. I don't believe. It could fall under the light version of the Section 179. I can't buy it through the business because I don't drive for business. My only drive for business would be commuting.
I'm sorry.
So unless I drive to Arizona, which heck no am I going to do to visit a client.
Okay.
So I've researched. I've gone through every iteration.
All right. I'm not surprised. And I do want to tell our listeners as we close out, Dave and I are on this BBB bill. We are not going to record until it's final because I've been through this too many times with too many tax professionals. It can change. We are going to record once it is finalized, once we know what the rules are, and we will update you on that. So there will definitely be an episode on that, how to take advantage of the new and be aware of what the changes are in the tax bill, but we're not going to do it until it is a finalized, passed, signed bill.
Yeah, agreed. If you've seen people release videos before it's been signed, they're taking a huge risk with their content because it might not be accurate.
Yes. And that's not helpful. There's too much noise coming at all of us today. I at least want to give you stuff that is you can do something with. I don't want you to go make a decision based on something that doesn't happen. I don't know. I just don't agree with that. Time is money.
Agreed. Jordan, go.
All opinions expressed by Dave Grant and Heather Townsend are solely their own opinions and do not reflect the views of their respective wealth management firms. This podcast is for informational purposes only and should not be relied upon for investment decisions. Nothing in this material constitutes a solicitation for the sale or purchase of any securities. Clients of Retirement Matters and Townsend Financial may maintain positions in the securities discussed in this podcast.
All right, and thank you for listening to this episode of Playbook of the Wealthy. You can find us wherever you listen to podcasts. If you want to watch the video version, it's on YouTube, it's on LinkedIn, it's on Instagram. And if you want to send an email to the show, whether it's just to say hi, get your question in, whatever it may be, you can email us at hello@playbookotw.com. And we'll see you next time.
Toodles.